betterhelp.com.
We're excited to do business with you, but before we sign, I gotta ask.
Sure, anything.
We searched you online, and maybe you can explain this?
Can't believe that garbage is still coming in. That is so false.
Frustrated with your online search results? Call Reputation Defender today to join tens of thousands who've improved their online reputation. Get your free reputation report card at reputationdefender.com or call 1-877-866-8555.
I had my dream career and loads of student debt. So I went to Credible.com and in 3 minutes had actual rates from multiple lenders, and I saved thousands of dollars.
Visit Credible.com to see how much you could save on your student loans.
25 seconds away from the opening bell here this morning. Good morning to you all. This Friday morning, we are heading towards a second week of losses with the equity market down 32, down 0.7% on the S&P, on the Nasdaq right now, down another 0.7%. That slow clap for retail sales about an hour ago. Big downside surprise. Let's your opening bell. Switch on the board in the bond market. That was a joke, I know. Not a good one. I'm tired. You are too. Long weekend coming up. Up 2 basis points on 10s, 172.74. Yields actually lower on the week after being much higher last week. Higher by about 20-odd basis points on a year still. Euro dollar heading south by 0.2%, 114.35 on euro dollar. A slightly stronger dollar in the mix here, with crude higher by 0.7%, up about 50 cents, advancing to 82.68. Looking at the early price action, the S&P down by 0.4%. Financials near the bottom of the pile here. We're down by about 1.4% around the opening bell. Breaking down the bank moves, here's Sonali Basak.
John, it's so interesting. You're hearing Jamie Dimon really set the tone for investors here, saying that the 17 return on tangible equity that's expected into the year ahead is a good number, even though it's lower than what we've seen. He said he'd be happy with 15%. But remember, in recent quarters, we've also seen the other investment banks that don't have large consumer operations really post very high numbers to that regard as well. So how do you compete at the end of the day when consumer is supposed to be the big story? Going over to the consumer, you are seeing a little bit of a lift in Wells Fargo. Remember, they are trading much more cheaply than JP Morgan when it comes to price to book ratio. And with that said, unlike JP Morgan, they're reducing expenses. So at the end of the day, are investors going to reward a firm like JP Morgan for playing offense, investing in technology, or a firm that is shrinking, frankly, and still facing some regulatory hurdles and a price a discount to contend with?
Sonali, give us the look forward, the look through. Go through these numbers and give me the look through to next week.
This is the issue. The trading environment normalizing and the fact that none of the executives have true answers for what it looks like is concerning, because what that creates is a lot of variability in an industry that a lot of people were hoping would be a lot more predictable this year. And as we know, Goldman Sachs and Morgan Stanley have two of the biggest trading divisions here, and the answer from them on what that looks like this year will be pivotal.
Sonali, thank you. Let's see if Goldman can get that execution up. Again, given what we saw through much of last year. That stock on JP Morgan right now is down 5.8%. The financials, worst performing industry group on my screen, down 1.8%. Baird weighing in on this morning's bank results, writing the following. We acknowledge the EPS benefit and leverage the higher rates most banks have, but it's getting priced in and then some. We aren't inclined to chase these stocks from here. You wrote that, David, going into these notes. And David George joins us right now. Going into these earnings, they were your thoughts. And David, I just wonder, with what you're seeing this morning, whether it makes a lot of sense.
It does. You know, these numbers this morning, Jonathan, have been fine and have been good, really. There's been very encouraging loan growth trends. Deposit growth continues to be very good. And credit quality is also quite good. But this is, I think, a situation, Jonathan, of just very high expectations going into these reports. Financials have become a very consensus trade so far in 2022, and you know, there's a price for everything. And while we feel good about the companies and their respective outlooks, the stocks are reflecting quite a bit going into these earnings reports.
David, can I just pick up on the expense line as well that came up in places like JP Morgan, places like BlackRock as well? Do you get the sense that's the start of something? For me and for many others, this is the first time in a long, long time that we're not talking about job cuts. We're not talking about people cutting costs. We're talking about them going the other way. That seems significant to me.
Yeah, I think we as financial services investors, Jonathan, have become accustomed to fairly limited and fairly subdued expense growth over the last several years. And that comes from cutting branches and just not really seeing meaningful wage increases on the part of their human resources. But I think we're in an environment for talent today where banks, financial services companies have to compete with technology companies for talent. And in addition to having to pay people more, there's a need to invest in technology and cyber and products and services that is kind of a double whammy that is driving expense growth higher. And this is not something that's really significant, but that rate of change, Jonathan, this year versus last year is certainly of note, as you mentioned.
The missing piece for a lot of people is the loan growth. David, any signs that that's turning around for you into 22?
Yeah, it is. I think one of the more encouraging things we saw this morning from J.P. Morgan and Wells Fargo is there is some signs of loan growth. It was roughly 3% at J.P. Morgan and almost 4% at Wells Fargo. And as the supply chain issues start to resolve themselves, you should see a pickup in commercial loan demand, commercial line of credit utilization. If companies don't have inventory to sell, there's really no need for them to borrow. But as that changes, I think that's certainly a positive as we go through the new year.
David, final word just before you have to run, because I know you've got a really, really tight schedule this morning with all the banks releasing earnings. Into next week, have you got a decent view now on what the rest are going to look like?
Well, these companies today are very capital market centric, but I do think that the biggest theme in thinking about next week is in terms of thinking about 2022. This expense headwind is something that I think investors may be underestimating a bit. There is if J.P. Morgan is going to invest, and they're the behemoth, they're essentially the Amazon of banking from my perspective. If J.P. Morgan's going to invest, they're going to raise the bar for everyone else. So I think that's something to think about for the regional banks that compete with J.P. Morgan. If JP's going to invest, it's going to force others to do the same.
David George, thank you, sir. As always, buddy, great to catch up with you from Robert Baird. J.P. Morgan down by almost 6% right now. Your broader market on the S&P down about 0.5%. The Nasdaq down 0.2%. For the year so far, it's been rising rates supporting the big banks. That's been the story. But that story has also been weighing on big tech. The Nasdaq 100 falling 5% in 22, the worst start to the year, going all the way back to 2008. Looking at this is Bloomberg's Katie Lyons. Hey, Kaylee.
Hey, John. Well, we've been talking about this growth to value rotation for some time. It seems the calls are always there, and yet it very rarely seems to stick. So far in 2022, though, it is sticking. If you take a look at it this way, the S&P 500 market-weighted index, where big tech like Apple and Microsoft has an outsized influence, is down nearly 3% so far this year. When you reverse the weighting so those big tech players have the least amount of influence, we're in positive territory by about 0.2%. And just from a value versus growth perspective, the S&P Value Index is up by about 0.5%, while its growth counterpart is down nearly 6 full percentage points. It really comes down to the rates equation, as you mentioned, John. Higher rates put pressure on stocks with higher multiples because it means their future profits aren't worth as much right now. And that forward PE multiple on growth is significantly higher. That index trades at about 26.5 times forward earnings, while value trades at a much lower 17.5. So it comes down to one question. Is this finally going to be the year where it pays off to be cheap? I say finally because that hasn't been the case for years now. When you look at the ratio of that S&P Value Index relative to the growth one, it has risen sharply so far in 2022, but looking on a longer-term horizon, that barely makes a dent. Value has a lot of catching up to do relative to growth, John.
Kelly, thank you. Thank you very much. Still with us, Sarah Hunt, Mike Wilson, Mike Schumacher. Sarah Hunt, I want to come to you and put together some of the pieces of the last 40 minutes or so. To what degree, to what extent is rate exposure really important to you right now to get that exposure in places like the financials in U.S. banks?
Well, we had already had a position in the financials last year because we thought that this was coming, and also because the banks looked really inexpensive relative to the rest of the market. I think that the rate exposure, it's going to be interesting to see what happens to the curve itself as the Fed starts to move, because right now that hasn't been enormously helpful because you haven't seen it steepening, you've actually seen it flattening. So I think that it's going to be about, this comes back to, are you getting growth and is it profitable growth? And can I look at that and say, where's the place where I can get some earnings out of this, but it's not earnings one at an already elevated multiple, but I still have some growth. And that's the tricky bit about value, because a lot of the value stocks don't have a lot of growth. And that still is going to be important going forward, but it has to be something where there's some sort of fundamental underpinning, which we haven't had to talk about in the last couple of years.
Mike Wilson, away from the index, where do you want to be?
I mean, we've definitely skewed more. I mean, we've made the switch to quality back in April, May of last year, and that was really a large cap growth call. And then we pivoted again in November to more defensive quality because of the view that we have that growth is going to now disappoint. So large cap defensives, and then we want to barbell that with small cap value because, as you point out a minute ago, while value at the large cap has really not outperformed growth much in the last 6 months, small mid-cap value has dramatically outperformed small mid-cap growth. So that's where the value is. That's where the real opportunity is, we think, in the value cohort.
Mike, when you've back-tested this, when you look at what happens when EPS growth peaks and defensive leadership starts to develop, how quickly after that does it start to develop?
Well, I mean, in terms of the fundamentals, I mean, usually it's pretty coincident. So I think the market is really, since mid-November, the defensive rotation has been dramatic. It's something that hasn't really been talked about much. I'm not sure why, but it's happening. And that tells us that we're going to be right about PMIs coming down significantly. So, we would say be overweight, the defensive parts of value, not the cyclical parts of value. I think and we're seeing a little bit in the financials today. The financials may struggle a bit, even though rates are going up, because, that is the cyclical part of value.
Mike Schumacher, that's where I wanted to finish with you as well, sir. Going deeper into the year, the scale of deceleration that we could see in this economy. Mike Wilson is looking at the PMIs coming back down towards 50. Mike Schumacher, is that what you're looking for too?
Yeah, it seems plausible. Probably a decent cutback in terms of growth, John. I think that's pretty likely a case here. And it does get back to that loop between inflation and monetary policy. How persistent is inflation? Therefore, how heavily do the central banks have to hit the brakes? I think that's going to tell the tale for the balance of the year, frankly.
Mike Schumacher, just a final word on that. On your call, when you tell clients that you're looking for 160 on twos by mid-year, what do they say back to you at the moment?
Well, after the laughter subsides and we go through the talking points, we say, look, if you really consider the idea of the Fed tightening pretty aggressively and, more importantly, setting the stage for a number of rate hikes beyond 22, beyond 23, and thinking about 24, then they say that starts to make sense. I think a lot of people have focused on the pace of the U-turn by the Fed and other central banks, but also it's the destination. So where does the tightening cycle end up? The market's priced for about 175 right now at the end of 23. We think that's too low.
Yeah.
So if the Fed starts to communicate that, then I think you can get a pretty big backup in the front end. So that's how we eventually get that conversation to work.
Sarah Hunt, Mike Wilson, I'd love to finish with you both on that. Let's just take Mike Schumacher's word for it. He's got the crystal ball. It's 160 on twos mid-year. Sarah, how would this market digest that?
I don't think that would be very well taken by the equity markets. I think that they are not expecting things to move quite that quickly. And the longer term issue for the Fed is also that we've got a much bigger debt load globally and in the U.S. itself. So higher rates start to translate into government spending shifting away from whatever else they want to do into making interest payments. So I think that there's a real tension with that as well. But I don't think that the equity markets would be very calm with that change in the 2-year that quickly.
Mike Wilson, final word.
Yeah, I would agree. I think that would be a curve flattening, and it would fit with our view that the defensive cohorts actually do quite well. So I actually agree with that setup. I think the curve will probably flatten later, middle part of this year, and it's not going to be great for equity valuations.
Mike Wilson, Mike Schumacher, Sarah Hunt, all three of you, thank you guys for working through the opening bell. JP Morgan down and down hard in early trading, about 12, 13 minutes in, down a little more than 5%. Coming up, President Biden approaching 1 full year in office.
The president has had, we feel, we've had a lot of success over the past year getting a bipartisan infrastructure bill passed. And what we want to do now is build on that in year 2.
The latest on spending up next.
6112.
This is Bloomberg's The Open. I'm Rishika Gupta, live in the principal room. Coming up, Michael Santomassimo, Wells Fargo CFO. That conversation 4 p.m. Eastern, 9 p.m. in London. This is Bloomberg.
Next week we'll announce how we are making high-quality masks available to the American people for free. I know we all wish that we could finally be done with wearing masks. I get it. But they're a really important tool to stop the spread, especially of a highly transmittable Omicron variant.
President Biden spotlighting bridge money in the bipartisan infrastructure law. Transportation Secretary Pete Buttigieg writing the following. Modernizing America's bridges will help improve safety, support economic growth and make people's lives better in every part of the country. For more, let's get to AMH down in D.C. Morning, Anne-Marie.
Good morning, John. We're going to hear from the president later today, and he's going to be highlighting where some of that money from the hard infrastructure package, that bill that he signed into law just 60 days ago, he is going to be talking about $5 billion going to repair some bridges and highways across the United States. And John, I have to say, it's an interesting moment to be doing this, right? Because we talked about this earlier, Greg Valliere coming out with really a blistering note about what he is calling the worst week for the president, given everything that has gone on with voting rights, the Supreme Court ruling down on the centerpiece of his vaccine mandates. This is a chance for the president to talk about something that most Americans can agree on, right? Fixing our roads and fixing our bridges.
You mentioned Greg Valliere of AGF. Let me just read out his words, Anne-Marie, for our audience. Joe Biden has stumbled through his worst week as president, stung by the Supreme Court, failing on voting reform, blamed for surging inflation, plunging in the polls. Anne-Marie, has it really been that bad?
It has been a rough week for the president. I mean, last night he was even trying to get through his own party when it comes to voting rights, which is going to likely fail in the Senate, by having over Senator Manchin and Senator Sinema to talk about what they can do and where they are potentially willing to negotiate with the president. And then, of course, yesterday the Supreme Court, Jonathan, says that his mandate about testing and vaccines for businesses over 100 people, well, that just doesn't go with what is in alliance with what the Congress has given to OSHA in order of what their statutory mandate is. And then many people have also talked about the fact that he might have went a little bit too far. Even members of his own party, given his Atlanta speech when it comes to voting rights. So this was a rough week for the president, but he's going to end it talking about something hard infrastructure. If that's enough to potentially cap off on an optimistic tone, we'll have to wait and see.
Well, Senator Warren is happy with his Fed picks. She says the following out of the statement. Raskin is tough and thoughtful, a tough and thoughtful financial regulator. That from Senator Warren just moments ago in a statement. That's Senator Warren of Massachusetts. Here's Senator Toomey of Pennsylvania, Republican. I have serious concerns that she would abuse the Fed's narrow statutory mandates on monetary policy and banking supervision to have the central bank actively engaged in capital allocation. Anne-Marie, you're better positioned than I to give some comments on this. How messy do you think some of these confirmation hearings might be?
I think she's going to be the hardest one, right? So you have Mr. Jefferson, which already we heard from President Trump's former head of economic counsel saying he wants to aggressively help to make sure his nomination goes through, and he would have had 100% confidence telling former President Trump to put Mr. Jefferson on the board. And then you have Lisa Cook, who, Jonathan, at a moment right now in history with inflation, she actually worked helping the Nigerian government in 2005. Nigeria in 2005 was dealing with double-digit inflation, nearly 20%. So these are some people that I think will be able to get through. But when it comes to Sarah Bloom Raskin, it's going to get very political, given her writings on climate change. And what Senator Toomey really takes aim at is the fact that he is worried that she'll push for choking off lending to some traditional fossil fuel companies. But yesterday, Jonathan, Lael Brainard said it. That is not the position of the Fed. So potentially that is something she is going to be able to use during these confirmation hearings. But potentially hers, I think, is going to be the toughest one to get through.
Yeah, Anne-Marie, I really dislike this, but I think we have to be transparent and open and honest about just how things are, the reality of the situation. Do you think, and I hope they get fair, open, honest hearings where people just take them for who they are, what their resume is, what their experience is. But as you know, the husband of Sarah Bloom Raskin is Jamie Raskin, congressman.
Yes.
Do you think that could make this just a little bit more messy for some Republicans who are supporters of the former president when Jamie Raskin, of course, led and helped manage the last impeachment trial?
Well, that's exactly right. He's not just any congressman, right? He is a congressman that helped lead the impeachment trial for the former president. This is another nuance to Sarah Bloom Raskin's confirmation hearings that is going to make it very politicized. Now, yes, Jonathan, you and I, we work in a data-driven world. We like to see people's resumes, like to see what their literature was about and their research about, which all three of them are firm economists and have done work, whether it's the Treasury or the Fed in their prior lives, have gone on to do a number of academic research. But no, this will become politicized because that is what Washington is, especially in this moment.
You hope that's not going to be the case, but as you point out, Anne-Marie, it often is. AMH down in DC. Anne-Marie, great work as always. Let's get back to these markets. Equities down a little bit at the opening bout, down a lot, then coming back some on the Nasdaq 100. Right now on the S&P, we're down 0.2%. The Nasdaq now positive 0.2. Breaking down a sector price action. Here's Katie Greifeld.
Hey, John, well, there's not too many places to hide this morning. You have 8 of 11 sectors lower at the moment. It looks like energy is your early oasis as oil prices climb. You also have technology fighting its way into the green, higher by about 0.5% after really taking a beating yesterday. Now, at the bottom of the pile, no surprise, financials leading losses in a big way after some of the biggest banks took the stage earlier today, and I know you've been talking about them all morning, but John, if it's not too overkill, let's stick with those banks because that sector, it's really been on a tear over the past year, up about 28%. But as we've learned this week, it looks like the fourth quarter was really a mixed bag. You had trading revenue trail off at JP Morgan, Citi, Jefferies, and looking at the price action this morning, traders aren't feeling too forgiving, John. You have JP Morgan shares plunging by about 5% at the moment. If that holds, that's going to be the worst post-earnings performance in about a decade, John.
Unreal stats. Katie Greifeld, thank you. Both Katie and Kaylee pointing that out. You can find that yourself on a Bloomberg terminal. If you load up JP Morgan and just enter ERN for earnings surprises, look down the right side of the column on the Bloomberg terminal and you'll see those surprises. It's been a long time since we saw a 5% move post-earnings on JP Morgan. That stock is down 5% precisely on my screen at the moment. Jamie Dimon's talking up rate hikes. Expect more interest rate increases than implied in this curve. Coming up, your trading diary from New York. This is Bloomberg. About 25 minutes into the session, let's call it 26. We're unchanged on the S&P now, reversing the move lower on the Nasdaq, positive 0.4%. Story of the morning, though, it's got to be the banks. Go to the banks, up big time year to date into today's session, then down some on JP Morgan off the lows, but still negative 4.7%. Wells Fargo having a massive year so far year to date. Citigroup a little bit lower, down 2%. For the first time in a long time, we're not talking about job cuts. We're not talking about pay cuts. We're talking about pay rises, hiring and investment. On Wall Street, it has been a while. That's the price action. Here's your trading diary, what you need to be looking for. You, Mitch, top of the hour. We'll hear from New York Fed President John Williams, 11 Eastern, followed by President Biden discussing his infrastructure plan this afternoon. Looking ahead to next week, a long weekend into China GDP on Monday and more bank earnings. From New York, this is Bloomberg.
Do you think we should call an electrician?
It's not that bad. We can probably figure it out ourselves.
I don't know. It's getting really bad.
Does it really bother you that much?
I'm sure it's just a phase. We can think about it some more. Sometimes you just need some help. So if you need therapy, find a licensed therapist at BetterHelp.com.
ButcherBox. We deliver high-quality meat to your door. What happens next is up to you.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Friday the 14th, 30 minutes into the trading day on Wall Street. What do you need to know? Banks, well, getting battered. It's been a good start to the year, but JP Morgan flagging slower loan growth and higher costs. Citi tumbling, trading disappointing there. Wells Fargo now up, but is having a volatile morning. Regulatory concerns continue at that institution. US retail sales sliding sharply in December. Was it inflation? Empty shelves? Was it Omicron? Or had everybody simply done their holiday shopping in October? And the White House nominates Sarah Bloom Raskin to be the Fed's top banking regulator, plus Lisa Cook and Philip Jefferson as governors. It could be a bitter battle to get them all confirmed. From London, I'm Guy Johnson. My co-host this morning, Kriti Gupta, Alex Steele, has the day off. Welcome everybody to Bloomberg Markets. Kriti, welcome to the show. We've got some data to get through.
Well, thank you, Guy. Yeah, we do. Michigan preliminary January consumer sentiment coming in at 68.8. The estimate there was 70. Guy, this is huge because you're starting to see that consumer confidence really wane as you continue to see those inflationary pressures at pretty record highs. Now, this is important because in December, we actually saw a bump up in consumer sentiment after 6 months of that dropping. Once again, those inflationary pressures in December, they were actually a little bit more confident, but it looks like that's turned around once again, probably in light of the consumer, kind of the Christmas shopping and simply the consumer spending. And it comes at a pretty bad time when you already see fiscal stimulus waiting, savings waning as well. So the question is, how does this really affect that end consumer story, that growth story that's been powering 2020 and 2021?
Yeah, I see the pickup in 5 to 10 year inflation. That's interesting. That's been stable for a while, but the consumer is definitely expecting significant inflation going forward. An expectation maybe that it fades throughout this year. That's certainly from economists. Consumers, well, they're not quite so sure. So, Kriti, we had a long discussion this morning about what our question of the day was going to look like. There's so much to chew on today. You've got the Fed. You've got the earnings story. You've got a lot to work through, but we kind of picked on the banks. I think probably that is a good place to start, a good place to kick off with earnings season. It's been an incredible start to the year. Did today, the news, particularly I think from JP Morgan, pour a little bit of cold water on that? So the question of the day is a simple one. Have the bank stocks already peaked? Let's ask Sonali Basak, Bloomberg Wall Street correspondent, and Romain Bostick, co-host of Bloomberg Markets The Close. Sonali, what do you think? It's been an incredible start to the year. We've got a rate story that we need to factor in as well. But today, I heard a lot about costs going up, and I heard a lot about trading going down.
Yeah, there's a lot of question marks up in the air, and that uncertainty is certainly spooking investors. On one hand, the top line is in question because there are worries about the sustainability of markets revenues. That's trading fees. There's also this concern that the consumer might not be rebounding as fast as expected. When it comes to credit cards, the ability to really make money off of them, this is at Citigroup and JP Morgan. At what point will consumers stop paying down their balances and start borrowing more to the point that this is going to be a real knockout business for the banks? JP Morgan is guiding that this will be higher, but remember in that card business also, in addition to labor costs across the bank, the card business, getting more consumers attracted to the bank is going to cost them money in terms of marketing and in terms of technology. Now, Jamie Dimon has been trying to get investors used to the fact that this will weigh on profitability, and let's see how long it takes them to get comfortable to watch a 17% or lower return on tangible equity be the new normal for the firm.
Romain, hop on in here because we're actually seeing perhaps the bank stocks, perhaps these numbers, a little bit priced in, a 20% rise in the last month in the KBW Bank Index. Yeah. How do you square that with the earnings we saw this morning?
Yeah, and it's not just the 20% rise that you've seen, but on a relative basis to the broader markets, what you saw here, really going back to mid-December here, you're talking something like 15, 16 percentage points outperformance by the bank stocks versus the broader market. You're talking about price-to-book ratios on bank stocks that are now back to their 2018 levels. So on a relative basis, there are a lot of people that are looking at this run-up that we've had heading into this earnings season as the rally. That's the rally you've gotten. And we've been here before. Remember, we've seen this in a couple of quarters last year and as well prior to the pandemic where you get this run-up in the stocks prior to these earnings reports. Once the earnings reports come out, yes, you have growth. Yes, you have some good news there, but there's always that fretting here that at those current valuations, there's really not much more room to go for some of these names.
Romain, the challenge here looks to be an interesting one. You've got the idea that interest rates are going to go higher. That, in theory, should be great for the banks.
In theory,
It should push up profitability. But then you've got the inflationary aspect to what is happening here, which is pushing up costs. Are we just basically going to see this not only for the financials this year, but pretty much kind of writ large across the whole earnings season? This is the challenge. You've got a huge demand story. You've got a consumer, despite today's retail sales number, that actually looks in good shape.
Yeah.
But nevertheless, the cost inflation story may just kind of inch ahead of that.
Absolutely. I mean, you talk about sort of what benefits the banks. Obviously, it's not just the rise in rates, but more importantly, a steepening of that yield curve with shorter-term rates remaining significantly below those longer-term rates. The problem is you've actually seen a flattening of that yield curve, so that eats into net interest margins. Now, that may sort of right itself once we start to actually get some sort of Fed tightening, but then you overlay that with this idea that maybe economic growth, maybe retail spending isn't going to be as strong as some people thought it was going to be, and that brings in some concerns. Take a look at the Wells Fargo numbers, which I thought were interesting. They had very strong loan growth in some areas, but you look at auto loans, for example, most of that loan growth was because of the value of the loan, not the volume of loans that they were making.
Sonali, talk to us a little bit about what the banks are saying, what the heads of these banks are saying. It wasn't too long ago that Jamie Dimon said that the 4 rate hikes that are priced into the market, well, the economy can handle that. We need 5. We potentially even need more. What else are you hearing in terms of the yields rising, but also this inflationary environment?
A few things. One, that point about the flatter yield curve, of course, that's a very big problem for the banks. And in fact, they have given some estimates on just how sensitive, and it's in the billions of dollars that could be at play here when it comes to how much money the banks can be taking in based on that steepening or flattening of the yield curve. So that's the variability that you're dealing with. On inflation, here's the other thing that JP Morgan said that is worth watching for, that while the labor costs were definitely a very key aspect of that tension so far, it could bleed into other areas. And while Jamie Dimon had said that many parts of inflation had been transitionary, other parts like housing, wages, oil are much more sticky. So how does that then play into not just for the banks, but also their clients, which will be hesitant to be spending and investing when they have to deal with those costs as well?
Sonali, talk to me a little bit about regulation, because this is where I'm curious, particularly with reference to Wells, where we're going here. We've just seen a new Fed banking regulator nominated. We've got Wells talking about the regulatory environment not easing in maybe the same way that some had anticipated for that institution, which has obviously been in the spotlight. How tough is it going to be from a regulatory environment going forward from here, not just for Wells, but for the whole sector?
It will be much harder than it's been the last 4 years or more. If you think about the headwinds that they have. The fact that the big banks have gotten so much bigger, and now you have JP Morgan investing at this rate. There was a guest that John Farrow was talking to about the idea that this will make it much harder for smaller, more regional banks to be investing. Why is that an issue? The community banks, the regional banks, they reach more lower income neighborhoods. They are really the heartbeat of so many communities when it comes to consumers as well as small businesses. So if they can't compete with the larger banks who are able to outspend them, then how do they compete, and how does the society get off the ground at the greater scale when it comes to getting credit? The other issue, too, that is worth keeping an eye on when we see the shift in the Fed is how they will handle climate change and how that pertains to the clients that the banks take on themselves. There's going to be a lot of existential shifts coming on. I've got to say another thing about Sarah Bloom Raskin really quickly, too, and the fact that she was there post-2008, so pivotal in the Dodd-Frank reforms. What does that mean for trading moving forward as the banks have slowly been taking on more risk in more recent years?
Romaine, we've got about 30 seconds here. I want to ask and piggyback on that regulatory scare. Do you start to see perhaps the nomination or the Fed pick of Sarah Bloom Raskin, who has been seen as a little bit less conservative when it comes to that regulation? Do you see that as having any impact on the market?
I think so. I mean, you know, this will be a much tighter regulatory environment should her nomination actually make it through. And I think you've already started to see some investors prepare for that idea. I think some of the big banks, they'll fare fairly well. I think it's some of those mid-sized banks that you have to keep an eye on. And don't forget about some of these, I guess, sort of non-bank financial companies, which will probably be in the crosshairs. Those are ones you want to keep an eye on as well, Kriti.
Well, thank you so much, Romaine Bostick and Bloomberg's Sonali Basak. We are getting some breaking news here from Wells Fargo. It looks like the CEO is speaking on his earnings call, saying that there is some softening in consumer spending post-Omicron. We, of course, will monitor you for that and bring those headlines here on Bloomberg Television. Coming up, Envestnet's Dana Daria favors financials. We'll get her take on those bank earnings next. This is Bloomberg.
What an interesting morning. What an interesting morning. The NASDAQ is now higher. The S&P is lower, only just. It's kind of flat. Financials, obviously a significant drag on the S&P today. They've had a cracking start to the year. The question is that already over? Are we about to sort of toss out the conventional wisdom that actually financials are going to do well in this cycle? That you maybe get sort of shorter, long duration assets such as tech? Huge discussions, obviously, in terms of portfolio construction around all of this. Dana D'Auria, Envestnet's co-CIO, I nearly said CIO, but co-CIO, joining us now. Dana, thanks very much indeed for your time today, and thanks for joining us. Look, the idea was that the financials would do well this year. We've now got a tougher regulator being nominated by the White House. You've got costs going up. Do those offset the idea that actually in a rising interest rate environment, you want to buy the banks?
Yeah, I would, of course it could, right? I would say everyone kind of knew we were going to get a harder regulator from the Fed on banks. So I don't think there's anything surprising there that's not already priced into the market. I think the natural dynamics, as you said, rising interest rate environment, banks do better. I think that, on the other side, longer duration assets like tech, where all of the value is very long term, get discounted a lot more in an environment like that. So I don't think 1 month or a couple of earnings coming out is enough to say, okay, the natural dynamics are offset here.
Dana, let's talk just a little bit about, you said that it was priced in about the market, but how much of this is also the outperformance, in these financial stocks is coming from perhaps a bet on this kind of rebound in value stocks, something that we started 2021 off expecting would thrive, and then we had that turnaround. How much of 2022 is mirroring that?
Yeah, that is a really great point. And depending on the measurement you use for value, last year growth did still outperform value, and certainly value is doing very well for a long time. It depends on your measure, how you're investing. I would say that prices still matter, right? And we are at a point now where by certain measures, the gap between growth and value stocks on a price basis are more than what we saw in the dot-com bubble. So I do think price matters. I do think eventually, and mean reversion, right? Which is just the tendency to go back to the norm, all works in favor of cyclicals, value stocks, et cetera.
The market thus far seems to have taken like 3-4 rate hikes really calmly. I know the NASDAQ is down, we're down like 4%, but if you'd have told me a year ago that we'd be talking about 3-4 hikes and the NASDAQ would only be off its record high by that kind of amount, I think you probably would have been a little bit surprised.
Yeah, a lot has happened for sure. The Fed really changed its tack, right? We spent the year hearing the Fed talk about inflation is transitory, we care more about full employment, we're not going to preemptively act, et cetera. Now you're hearing pretty much the exact opposite in terms of the rhetoric. You're hearing hawkishness. FOMC says about 3 hikes. We know that hedging, the forward curves are saying more like 4. So we've definitely switched, where mindsets are. But let's not forget, it's a long way to go, and there's a lot of information that the Fed can take in between now and the end of this year, right? So if Omicron is not as manageable as it appears right now, if growth starts to taper off, if we have a flattening of the curve, the Fed's going to be reactive to that. They're going to pay attention to those inputs and not necessarily just keep hiking.
Dana, I'm so glad that you mentioned that the market is pricing as many as 4 rate hikes. If you actually look into the curve going out to 2024, some people are saying as much as 8 rate hikes between now and then. I'm curious, though, how much you think, say, the 10-year yield can really rally as you have these conversations been going on for months on end.
Well, we are seeing that starting, obviously, now, right? I think because Omicron looks more manageable, so folks are expecting higher growth. Obviously, we had the retail report that in December it wasn't as good as we thought, but it's one month, right? I do think that treasuries are going to continue to rally. I do think, the information I get, there's sort of a band around that, right? So do we get to 2%? And really that difference between whether we're steepening or flattening, I do think makes a difference in the Fed's movements. And it remains to be seen. Growth is going to be a big driver.
What do you think is going to happen with some of the other assets that we're watching so carefully? One of the things that I think has caught some people on the hop already so far this year has been dollar positioning. The dollar has weakened. I know it's not today, but you've still got a euro dollar at 114. You're starting to see other markets around the world maybe looking a little bit more attractive as we see maybe positioning changing around the buck.
Yeah, it was interesting last year to see such strength in the dollar, given how dovish we were, how much stimulus we were pumping in. But the reality is ex-US even more so, right? So it's all relative. I think the dollar actually probably continues to stay strong to a certain extent because other economies are behind us on the tightening. We're more hawkish at this point. But I don't expect to see the same level of strength, right, as these other economies catch up in the tightening cycle.
So it kind of sounds like you're saying that there shouldn't be this divergence necessarily in the dollar and yields that we have seen in the past couple of days. A lot of that, like I said, is going to be positioning that's coming up. But you seem to say that that's not going to happen, that the dollar still has some strength to go.
I think so. Yeah. I mean, just the overall dynamics of the situation. And, you know, short-term volatility, it's hard to say what drives any of that. But I think, you know, when you're looking just out at the next 6 months to a year, as long as we remain as hawkish as we are, as long as we do embark on these rate hikes, tightening, right? The Fed is talking about using its balance sheet to also tighten. I think the dollar can continue its strength.
Dana, do you want to be fully invested right now? Do you think there are going to be opportunities this year as a result of the volatility if you've got cash on the sidelines? Are we late cycle, and how do I think about a late cycle environment in terms of managing my positions, maybe kind of taking a little bit more opportunity, maybe not just being fully invested, maybe thinking about kind of entry points and exit points?
Yeah, it's a fantastic question because my thought is that probably a lot of people at this point are over-invested in equities relative to their risk tolerance, right? We had a bull market. You know what happens if I'm a 60-40 risk tolerance, let's say, balance, I enjoy all that appreciation in my equities, and then I have really more than I can probably tolerate losses in. So it's definitely a time to be looking at your portfolio and saying, okay, am I at the right risk levels? Do I need to moderate? I think everyone is expecting lower growth this year, probably more volatility, right? You're not 28.7%. It's just, you know, base rates alone, we're not likely to hit that. So looking at your positions and saying, okay, do I need to trim some equity exposure? It's not to say you shouldn't be in the markets, though. It's really more about being in the markets at the level that you can tolerate the loss.
Well, Dana, you just mentioned that volatility. Let's kind of bring the conversation full circle back to where we started with banks. How much of that expected volatility that we're going to see perhaps in the equity markets, even the commodity markets, or even say the bond market, is going to factor back into those trading profits for some of the big banks?
Yeah, you know, volatility kind of begets volatility, so it's going to be interesting to see. I mean, if it does transpire that we get more volatility, I would expect it kind of builds on itself, right? So yes, banks and, you know, obviously cyclical sectors are facing that contingency. But on the other side, we are looking at a situation where with luck, Omicron is sort of the beginning of the end of this pandemic. The reopening trade comes back for us. And we see the economy, energy industrials, et cetera, kind of coming back for us.
Well, Dana Daria, Investment Co-CIO, thank you so much. We really appreciate your time. Still ahead, though, down, then out. Fans of Cathie Wood's ARK may finally be losing hope in the ETF. We've got more on that next. This is Bloomberg.
Earnings season is coming.
Q4 earnings are going to be awesome.
Bloomberg is fastest with the numbers and analysis.
Amazon crossing the Bloomberg terminal. Where are investors seeing the weaknesses?
It
means profits down the line.
Earnings season on Bloomberg Television and Radio.
Well, time now for ETF Friday. Fans of Cathie Wood's ARK ETF pulled $352 million, the biggest outflow since March. Joining us now is Eric Balchunas, Bloomberg Intelligence ETF analyst. Eric, should we just lose all hope for that high beta tech play?
Well, the trade itself is really roughed up. I mean, if you look, it's down, ARK is down 45% since last February. That is nasty. That's the worst drawdown in ARK's history. I've seen ARK go down like 30% twice before that. But those 30% drawdowns really showed us that there's something about her and her investor base that's pretty into it. So if you look at the flows, the 350 you mentioned, 3 days before, it took in about 350 million. So there's been more of an in and out of ARK, which is a good sign. We've seen ETFs in the past sort of rise, and then they see outflows, say, like every day for like a year. This is not this. There's a lot more in and out, and the volume is really high. And that tells me there's a little bit more of a tug of war going on than there is, say, a mass exodus like you tend to see from past high flyers. So we're pretty bullish ARK will be around for a long time, although right now it is in a real bad spot.
Eric, in terms of what is happening here, Cathie Wood, she's all about conviction. And I'm wondering how nimble she's being right now in terms of managing the positions that she's got. You talk about the in and out of the trades into the ETF. What about the ETF itself? How much is that changing as things evolve?
Not a lot. This is part of why I think people stick with her. A lot of people have Vanguard or cheap index funds in their core. So they don't necessarily want Cathie moving into, I don't know, big safe value names right now. They don't want her trading around. They like the fact that she's committed to this disruption, non-profitable tech-type basket. And I think that's good. So her consistency, I think, is a benefit long-term. That said, right now, it looks a little almost like a suicide mission to keep buying these stocks that have been going down. But if you know Cathie, you know she just looks at them as stocks she likes that are now cheaper. So she really does walk the walk. And I think that actually benefits her long-term. But in the short term, it's definitely hurting a bit because of the drawdown.
A bit, maybe a bit of an understatement. Eric, thank you very much indeed. Greatly appreciated as ever. Cathie Wood, as I say, all about the conviction. Eric Balchunas joining us from Bloomberg Intelligence. The Wells call is underway. Citi holding theirs in around half an hour. You've got the KBW Banks Index off its lows now, but still down around 0.7%. So many takeaways from the call today. We'll dig into the details. We'll figure out where this sector is going, where these stocks are going. Gerald Cassidy of RBC Capital Markets is coming up. We'll get his take on what is happening here. The bank sector certainly in focus today. We'll deal with the details next. This is Bloomberg.